international balance. By way of introduction, I was the former financial secretary in Hong Kong, and right now I work for the Blackstone Group. A lot of people have commented that there is a lot of rivalry between the two economies, the economies of China and that of America. Right now, we are in the middle of a financial crisis, and we have seen comments from both sides of the ocean about the responsibility, what caused the financial crisis. Obviously, a lot of people said that the U.S. caused it because of overspending and over-leverage. But then there are others that point to China, saying that because of the over-expansion of capacity and also the over-saving, it caused a huge imbalance, and that led to the current financial crisis. Obviously, a lot of people have also commented that maybe with China growing at 8% or slightly less, with all the stimulus measures that they are undertaking, maybe China can help save the world. Other people have pointed out that China is now the third largest economy in the world, and maybe in a few years' time, it will overtake Japan as the second largest, and maybe one day it will challenge the United States. But obviously, others would like to point out that while that may be the case, on the per capita basis, China is still only a fraction of that of the United States in terms of per capita GDP, and it will be a long while before the United States will be surpassed by China. Others have also pointed out that right now, China has a large foreign exchange reserve, $2 trillion, and the bulk of it is held in US dollar. Will China change its mix of foreign currency holding and therefore threaten the funding of the United States current account deficit? And then there is the issue of the renminbi. Right now, with the United States accounting for a quarter of the world's GDP, but accounting for the US dollar accounting for about 60% of the world's foreign exchange reserve, with the renminbi becoming more internationalized, will it one day become a reserve currency and therefore affect the status of the United States dollars? And then there are observers looking at the trade and investment flows between the two countries. While they observe that while the Chinese have been pursuing opening up and reform policies for the last 30 years, we are seeing in the last couple of years an increasing amount of outbound investments from China. While that may be a good thing, but we are also seeing signs that the flow may not be that smooth. We witnessed the CNOOC failed attempt to buy Unicel, and recently we have seen on the other side Coke's failed attempt to buy Huiyuan. All of these shows that there are possible signs of rivalry, or at least friction, but on the other hand, there are also a lot of room for cooperation. And today, we are pleased that we have a very distinguished panel to address some of these issues. The first to speak to us would be David Richards, who is a private investor since 1991. He's based in Santa Monica, California. Before 1991, he was the managing director and vice chairman of Prime Cap Management in Pasadena, California. He now spends a lot of time on, I would call them the public service. He now serves on Harvard's Committee on University Resources, the Dean's Council on the Faculty of Arts and Sciences, the Dean's Council on the Kennedy School of Government, and the Better Center. He is a Foundation Fellow of Wickham College and member of the Chancellor's Court of Benefactors of Oxford University. At the Rank Corporation, he is on the board of advisors of Rank Health and the Center for Middle East Public Policy. After David, we have Professor Zhang Yuning. Professor Zhang is the director of the Institute of Asia-Pacific Studies, the Chinese Academy of Social Sciences. He's also a member of the Foreign Relations Committee National Committee of the Chinese People's Political Consultative Committee. He is also chairman of Academic Committee for International Studies of the Chinese Academy of Social Sciences. Last but not least, we will have Stephen Clements, Senior Fellow and Director of the American Strategic Program at the New America Foundation. The American Strategy Program at the New America Foundation promotes a new American internationalism that combines a tough-minded realism about America's interest in the world with a pragmatic idealism about the kind of world order best suited to America's democratic way of life. He is also a senior fellow at New America and previously served as executive vice president. He is the publisher of the popular political blog, The Washington Note. He is also a long-term policy practitioner and entrepreneur in Washington, D.C. And with that, David, would you like to make a remark?
Thank you very much, Anthony. I'm honored to be here on this distinguished panel, except for myself, who is not an academic or anybody of note. I'm a private person, and nobody really knows much about me. What I'm going to talk about today is about the crisis that we're in, the nature of it, why we got into it, how to get out of it, and put it into some perspective about how it differs from the crisis that it's usually compared to, which is the early periods of the 1930s. And I think the historical perspective will be very useful in giving us a good deal of hope about what is about to happen, or which actually may already be happening, which is we're coming out of it. So I'm going to end this on quite a positive note. In the 1920s, the disagreements between the major powers were heavily derived from the reparations that were put in at the Treaty of Versailles. They were basically enormous debts put on Germany to pay for the war. The debt was created without any exchange of money at the time, and Germany really couldn't pay them. It was known that they couldn't do it. Keynes wrote about it. And this reparation was a source of conflict, major conflict between all the great powers. Germany owed France, France owed Britain, France and Britain owed the United States, and there was a great deal of reluctance to get rid of this debt that had been created out of thin air. The second issue that they had then was an interest and actually a belief that the gold standard was the only way to run an international system, and this created problems when Britain went back on the gold standard at the pre-World War I price, even though their economy, in terms of human capital, had been greatly diminished because of the deaths in the trenches in France. And it was unsustainable, and the American Central Bank tried to offset the drain of gold out of Britain and the constraint on the British economy by engaging in a very easy money policy in 1926, 7, 8, and this set off a huge credit boom and stock market boom, somewhat analogous to what we have had here, and that when it came to a crash, and you began to have the contraction, and it's familiar to us because we've seen it happen, the Federal Reserve and the other central banks, first of all, didn't work together. And secondly, the Fed was totally disorganized. Benjamin Strong had died in 1928. There was no strong leadership. The presidents of the individual 12 banks had much more power over the Federal Reserve Board than they do today. And as prices went down, they didn't do anything in terms of stimulating. They haven't done what Mr. Bernanke has already done in great quantity, cutting rates and increasing excess reserves in the banking system. And when Britain went off the gold standard in the summer of 1931, the Federal Reserve, after you've had 2 or 3 years of very sharp price declines, totaling probably 30%, they actually raised interest rates in the fall of 1931. So there was a contractionary policy. There was a great deal of lack of understanding of what was going on. And It was only when Roosevelt took power in March of 33 that things changed. They changed very dramatically. The Federal Reserve, that had been hampered in part because of something called the gold clause, the gold standard belief that you couldn't offer money, the Fed couldn't expand the money supply without having gold backing, was abolished by Congress, and the Fed immediately went on a very easy money policy. Soon after, the banks were reopened a week or 10 days after Roosevelt took power. This set off a major recovery in the economy, a major recovery in industrial production and in the stock market. As a result of this change in policy, it's important to remember that the Depression was not just down and flat, it was down and then up sharply. Between 1933 and 1936, the economy expanded 45%. Industrial production doubled in those 3 years, and the stock market tripled. So the result of this monetary change resulted in a major boom, which was cut short in late 36 because the Federal Reserve became concerned about inflation. They doubled the reserve requirements. Roosevelt cut back some spending programs, and the economy and the stock market went down again. But it's important to realize that that powerful policy of expansion worked at a time when price levels and the debt burdens were comparable to what they are right now. I got to get a bit of water. Like the period of that preceded the Depression and the ongoing downturn in the early 30s, the U.S. situation resulted from mistakes, policy mistakes, not only by the United States, but also by China and their central bank. And the central bank of China's mistake basically was to sterilize the credit that otherwise would have expanded the domestic economy, increased the inflation, probably in China, increased export prices, given the United States authorities a better sense of the inflationary policy they were conducting in terms of monetary policy, and it would not have concerned the Federal Reserve with the possibility of deflation when they were concerned about it. They would have been much more concerned, I think, about the credit growth that was taking place. They had bad signals. The consumer price index did not go up. The Fed and other authorities in the government and in the academic community were not concerned about asset inflation, which clearly was going on. It wasn't a mystery that loans were being made on a very unsound basis to houses and for other consumer goods throughout the economy. The second part of this, in other words, the Central Bank of China fed credit into the U.S. system, and also their policy sort of obscured what the inflationary policy, monetary policy of the United States was. The second part of it are the mistakes that the United States authorities, both the central bank and particularly the regulatory authorities, and with some blame on the part of the academic community on the economic side, the business school side, and believing that markets should never be regulated in any great sense. There was a sense that regulation was not the thing to do, even though the history of financial markets is such that we know that banking and insurance have to be regulated because they are basically involved in promises where the payment of the money to obtain the promise precedes, there's a lapse of time before the promise is actually fulfilled. So there's all sorts of opportunity to take the money and run. And the major area where this did not work was not so much in insurance or even banking, it was in the credit default swap market. And credit default swaps grew on a private basis, sort of in the dead of night. They were private markets. It wasn't exchanges. People didn't know, except in the major financial institutions, what the pricing really was. And there was an entity called AIG who was writing these credit default swaps by huge amounts and doing it in a way that was very much underpriced. The credit default swap has two types, basically. It's the same entity, but they have two different sort of ways of looking at it. One is it is an insurance policy if the underlying bond is owned by the entity buying the insurance. It's like buying insurance on your own house. The other way is to buy credit default swaps, which you could do without actually owning the house, in effect, without actually owning the bond. This is nothing but a gambling casino entity. And in fact, it gives the buyer of the credit default swap the incentive to see that the entity goes bankrupt. It's a very perverse, dangerous thing. And the writers of a credit default swap should know that there should be, in the pricing of the credit default swap, a cost of capital, i.e. a reserve assumption. They have to have reserves for the possible payment of the promise that they've given if there is a bankruptcy or a credit, let's say a credit default event. And AIG believed they did not have any liability. They were never going to have to pay off. They incorporated no cost of capital in their pricing. And because the rating agencies believed that if there was a credit default swap written by AIG that initially had a AAA balance sheet, this became a AAA liability on the part of the issuer. And this, for regulatory purposes throughout the world, could be purchased by banks or insurance companies with minimal, almost zero capital required by international agreements that were drawn up at Basel. So this was a regular way to get around regulations, and the result was credit was underpriced, and there was too much of it, leverage was too great, and the whole thing was written in a way where there were no reserves. When Lehman went under, suddenly AIG had a big liability. Other people had a big liability. AIG could not pay. AIG had to be taken over by the government. And what this meant was that you had an enormous scramble for collateral by the counterparties, the writers of these credit default swaps, and that collateral took the form of U.S. dollar cash or U.S. securities issued by the United States government. And so this resulted in a market where everything was sold, stocks, bonds, commodities, gold, and other currencies, British pound, etc., and the dollar went up because there was basically a margin call on dollars, and this resulted in this huge financial crash. Now, that was a big mistake to allow Lehman to go under, but it happened. The result, unlike what happened during 1930, 31, and 32, is that the Fed and the authorities on the fiscal side immediately have stepped on the gas. And this is not just in the United States, it's throughout the world. These are huge fiscal and monetary stimuli that have been in place, and the result is that you have increased the amount of collateral out there in the system to offset the potential still sizable liabilities from credit default swaps. AIG is actually owned by the United States now, 78, 79%. And so the risk of a further margin crash here, I think, is very, very minimal. With rates at virtually zero throughout the world, you have a huge incentive for banking institutions all over the world to lend money. They can lend it out at 4, 5, 6, 7%, and with zero cost, this is extremely profitable business. And lending is beginning to happen in a way that it hadn't before. The spreads between lower quality and higher quality debt are narrowing, and the stock markets all over the world have recovered since early March, and I think we're on our way to further expansion. And I just end the comment by just saying if the experience of the early 30s, that is from 33 to 36, is any indication, it's entirely possible that we could be very surprised about how rapidly things do recover around the world. And I'll leave that with a very hopeful comment to you and my next speaker. Thank you.
Thank you, Chairman. First, I will talk 2 points. One is how to understand the current crisis. We all understand this current crisis started from the United States, from some prime credit crisis, and then quickly spread to the other sector, and also very quickly spread to the whole world. But the root of this big crisis is so serious, so widespread, I think has its foot in this long accumulation of, I called it 3 grand imbalances. The first imbalance, it is production and consumption in a global level. And simply to put, that is, producers do not consume and consumers do not produce. So it's grand, or even say that producers consume too little and consumers consume too much. So the second grand imbalance, that is real economy and virtual economy. And the virtual economy becomes so large, it's much beyond the need of the real economy. So the third imbalance, I think, that is the so-called financial innovation and monitoring, the big gap between the two. Both China and U.S. now are involved in this big imbalances. So we are partners. We have a lot of shared interests, and also we have a lot of shared responsibility. So the scenario, either it's win-win or lose-lose, not a win or lose. So we have to find a way to work together. As much relating to our book, we found a way. So there is a book just newly published in China. China does not feel happy and considered to be very extremist, nationalist. Actually, both of us are not feeling happy in current crisis. The second point, I think, with this understanding, what can we do together for China and the United States in this economic area especially? The first thing I think we should do together to stabilize the economic situation. Firstly, of course, on our own, and to try to recover as quickly, as early as possible. Since China and the U.S. together accounts for 1/3 of world GDP, but of course China is in a small share. But however, if you consider the past global economic growth, the two countries jointly contributed almost half of the new growth in the past several years. So the stability and early recovery of the two economies are crucial to the global economic health. And Chinese economy actually has been seriously affected, but we actually did not expect the impact is so serious. Until the first half of last year, the Chinese government policy was still focused on the cooling economy, controlling inflation. So this policy started from 2007, and the first change of the policy, but very light, only from September, the first time to lower the interest rate. But only until December that government started to take serious measure to solve the new problem. Because in November, both foreign trade and industry show that's bad situation. And especially foreign trade started to show the big decline. So that's one government. You have to quickly and drastically to change your policy. And so there is almost a big overturn if you compare the first and second. Why? Because this economic crisis. But why is it too late? Because we did not expect so serious. If we remember even in early 2008, people still talk about the delink and whether, Asia, China could be fortunate to have a different economic situation. But only until October, especially from November, we seriously realized the situation is very, very serious. And so Chinese government, I think, in December adopted this well-known, this big package, the 4 trillion Chinese renminbi project, the program, and plus additional several measures, including the encouraging more consumption by the consumers, especially the rural population. So until now, it seems this policy has got the positive reflection. And the first quarter of Chinese economy, the GDP growth rate is 6.1%. Compared to the last quarter of 2008, that was 6.8, but still lower. But this 6.1 growth rate is better than we expected. Because why? Taking the GDP in the whole quarter, the figure, it seems lower than, but in February, especially March figure, data is much better than expected. For example, in March, the industrial output growth is 8.3%. Fixed investment capital increased 28.6%. The retail growth rate is 15.9%. So it's a show that big uptrend. And import and export, the foreign trade, continue to decline. It's the negative 24%. But in February, it's 26%, so lowered. But if you compare to the March with February figure, they show the almost all increase of this export and import. And in imports, for instance, from US, from Asia, it has a larger margin. So more importantly, which I would like to point out, that is the 6.1 growth rate, that is contribution from internal demand is 4.3%. Investment, 2%. Foreign trade, 0.2 negative. So, but by this new policy, that seems internal demand increase contribute most of economic growth. So it was saying that probably the Chinese economy would be the first to be out of this current global economic crisis shadow. I just say shadow. But we still have many long-term problems because, as I mentioned, this imbalance problem, we still need more effort. But actually, this government pay attention to this short-term, immediate measure and the longer term. Because, for instance, in this 4 trillion package, 40% spending on infrastructure, 20% around on the post-earthquake reconstruction, the other parts mostly on social spending. which is social spending, improving that social security system, which is longer term rather than immediate term. So that's the first thing I think both China and the U.S. should do more to stabilize and to recover its own economy. That's very crucial for the whole global economy. The second area I think we can do together, that is international financial system, the reform. And we already have witnessed the shared interest and stance in the G20, latest G20 meeting. And we all support the reform and change, especially for China. I think China considers this priority reform area is to strengthening our monitoring system, improve and strengthen international monitoring system, and especially to have a strong vehicle or measure in the future to monitor, regulate the cross-border capital flows. The second that point that China expects, that is, of course, for U.S. Financial system itself. And China expects that U.S. would do more to improve and change its system. As Prime Minister Wen Jiabao said, our money in your pocket, we concern our money, we concern our wealth, so please do better. So this reform, actually, crisis coming from U.S. I think U.S. has done many already, but it's not enough. So China support this reform. The third point China's concern is China really supports a gradual and stable change and reform rather than a radical. Probably people put the question on why Zhou Xiaochuan published an article before G20 and calling a new international reserve currency. Personally, I think it's just an intention, the view for the future reform of international monetary and financial system rather than an immediate step which we should take. Because this kind of debate, if you recall, started from 1960, 70. So it's a long time debate. And it seems this idea has got support from many countries. But we all realize that it's one of the options probably. And also we need more time to consider because we all understand that create a new international reserve currency unit or SDR like, for instance, is not an easy thing. And probably it's more vulnerable than the current dollar. So we have to consider it how to. So I think that's very popular view. That does not represent the Chinese official stand and try to just overthrow the current system, because as I mentioned, our money in actually most of our reserves are wealth in the U.S. dollar. And also in the current international system. So China is a reformer, support this stable transition. Of course, we have the other areas like we will often pick up as, international areas like in the climate change, energy, and so on. I just mentioned this international financial system. The third area, I think, is cooperate in this regional integration and cooperation. Actually, China, U.S. shared one big region, that is Asia-Pacific. We already have this institutional building that is APEC. And of course, there is a region which China shares, but without U.S., that is East Asia and Asia in large. The U.S. concern, of course, is what China is doing on this part without U.S. And I can tell you we had done a lot, but its progress is not so quick. Like 10+3, and there is a framework for leaders' dialogue. But because of difficulty in Thailand, and even the leaders' meeting cannot organized. But in the financial area, we have CMI, Chiang Mai Initiative, based, and we have the progress from bilateral swap arrangements to a more regional based. And also we agreed on the enlarged pooling reserve. But this reserve, to understand, it's not money put in the one basket. It's reserve commitment, rent money in the other places. I think it's still very difficult to moving from current regional swap networks to a regional monetary fund. On this trade area, we have a 10+3 study group. And a study group chaired by me coming from 13 countries, and decided in 2004 when we gave the report to leaders, and then it was considered too advanced. So our studies still continue, and I hope that we can have an early arrangement and for this EA FTA called East Asia FTA, but it's not an easy thing. But even this, I think it's not, because it's not totally exclusive, because our East Asia production network is well linked to the outside, especially to the U.S. economy. So what China is doing, I think, in this East Asia or Asia in large, that is first because China becomes a very important player and partner. So China use this regional cooperation to defend and expand its interest together with others, and also try to use this economic leverage to improve the relations with these neighboring countries. So China really has no intention to, based on the well-designed program, that is to get the U.S. out, actually. So as previous session said, China's regional concept is, one is not very narrow because China has a larger area surrounding rather than just East Asia. We have also SCO. We also have Northeast Asia. The three countries just start from last year, have the first trilateral leaders meeting. The second one will be happen in China this year, and third one next year in Korea. So we all understand this is just a very, very preliminary step. So, but it's good than none. So this confidence building. So this is not for U.S. It's not, it's just for how to handle our old and new emerging complex relationship and improve the benefits of the region. And also, as I said, we have shared the region. We have a ready institution that is APEC. We should make more effort to strengthen it. APEC's credibility has been declined very sharply. But next year is a crucial year, that is 2010. The 2010, we should remember, that is the goal of BOGO goal, the first stage. That is, the developed economies should realize BOGO goal next year. But we all realize it's not easy. Seems not possible. But we have to convince the regional members that we have some new thinking and to keep. So the Obama government, I think, is thinking from now how to revitalize APEC as a broad framework, which really are important, and also to put China, U.S. in the one big region. So we have. I don't think it's necessary for somebody talk. U.S. should join EAS, that is ASEAN +6, and why you should, bring a big bag and to move to Asia, and instead you build a house here and to invite India, the others come to Asia Pacific. That's a light loan, and then we can do more. So let the others do something. So U.S. probably should change its minds, and though it's a global power, but to let the other things others to do something without you, not necessarily you are everywhere. So this is a new change, I think. And also China, at the same time, also understand, as previous session said, we recognize U.S. military presence, U.S. interest, you have the interest, but however, we do not expect, you are everywhere to do everything necessary. So we have to create a new shared understanding to based on the trust. This is also very important in this economic area. So aside from the book, what we wrote, so I give some points. Thank you so much.
Thank you, Professor.
Great. Thank you very much for having me today. I know it is awkward to be the last speaker in a program right before drinks. I want that drink too. As you can hear from my voice, I've been doing a lot of speaking over the last day on another important relationship, the U.S.-Saudi relationship, and got me sort of thinking about big stakeholders in the world. And of course, China is I saw Joe Nye here. I know it's not announced. Is Joe in the room? I don't want to get in trouble with Joe. We all know that Joe might be ambassador to an important country. I won't name it, not China. But it is interesting and makes one reflect on Ambassador Mansfield's comment then about the most important bilateral relationship in the world was the U.S.-Japan relationship, bar none. And I think it's very hard not to make that case today for the U.S.-China relationship. I think it's substantial. I think, and I think it has significant warts, which I'm going to get into. But I want to say what a pleasure it is to be here with Richard Rosecrans. There was a time when I started out at a very young level at UCLA and RAND, and was working with some of the top Sovietologists in the world, that I was their slave at the time, and looking at how the tectonics of global power and world order were being talked about and discussed. Until Rosecrans wrote his book on the trading state and brought the sophistication and thinking about economic weight to power, Kissinger couldn't talk about the weight of economic power in the world. And Richard Rosecrans has changed the landscape of how we think about rising powers and power in general. And I think I tell people I am a Nixonian realist who was corrected and put into a hybrid form by Richard Rosecrans. So it's such a pleasure. And to see people like Bill Breer here and Ezra Vogel, what a pleasure to see Ezra here. So I want to just say hello to all my friends. True story. About 3 years ago, we had Hu Jintao in town, and I made friends with then the director of the policy planning staff of the Ministry of Foreign Affairs in China. Got him his picture with Colin Powell. He was thrilled. We've been best pals since. So I went to see him in Beijing, and I said, "What are you working on?" And he says, "How to keep you Americans distracted in small Middle Eastern countries." And it was a very interesting picture that, while a joke, has a seriousness to it that I think we ought to pay careful attention to, particularly when we're looking at how America, whether it's rising or falling or floundering, where China is going. It's very important to know that no matter how you look at China's rise in the world, and I would go back to something Francis Fukuyama wrote, where essentially China has been able to build a set of global groupies, if you will, a set of networks and relationships in the world in an environment where it didn't have the natural competition and distractions of American engagement with other parts of the world. And to some degree, we've got to kind of come back. And I think that distraction of Iraq has created I think China has not been nefarious, but created incredible opportunities. There's a man named Matt Cooper, some of you may know. He's a journalist in town, formerly with Time Magazine, now Condé Nast. He was involved with the Valerie Plame scandal, didn't want to give away his sources. And he was invited down by the Organization of American States to give a talk on journalistic ethics in Uruguay. The sponsor was the Chinese Ministry of Foreign Affairs. His honorarium was paid for by the Chinese Ministry of Foreign Affairs. This is just a small microcosm, in fact, of the deep breadth, I think, of China's engagement in many parts of the world, that for our distraction in the Middle East we've become distracted from, and it has to be corrected. What's interesting about the situation is I do believe, for a lot of reasons, if anyone reads my stuff, and I regret it, I'm not a declinist, a wanting decline. I am angry and frustrated as a somewhat of an American nationalist at how badly America's portfolios in the national security and economic area have been managed. It's hard to imagine a president of the United States being handed two crappier portfolios than the ones he got. And so 100 days in, it's pretty remarkable, I think, how well President Obama is doing. But when you go and you look at China, you listen to China, there are exceptions, as we heard from the Chinese central bank chief and others. But on the whole, I think China is very, very concerned that it does not want the optics, at least, of global order to change. It's working very, very hard to try to maintain, do what it can, to maintain the order of essentially a U.S. liberal order in which it has significant stakes. But it's very, very hard for China when you're partnered with the United States, you've invested in the United States, and what has this great superpower done? It went and it showed key military limits in Iraq and Afghanistan. When superpowers show limits, the first thing to go are the trust of allies. The second thing that happens is your adversaries begin moving in different directions. Then we... Dr. Zhang mentioned the economic crisis starting in the United States. We did it, so we pulled to China to some degree. We exported toxic financial products to the rest of the world. This had intravenously devastating consequences. I disagree with Dr. Zhang that that was fundamentally what happened, and we'll talk about it in just a little bit. For anyone in Los Angeles or Japan who's familiar with earthquakes, I was in the Northridge earthquake, right in one of the spokes of that earthquake. It was pretty scary. But it's a small earthquake and did a lot of damage. But the San Andreas, and if you can imagine the subprime crisis being a serious earthquake fault that ruptured the San Andreas, that's what I think has happened today when we look at the question of global imbalances and what we need to do about them today. So yes, the United States triggered an action. But let's be honest, and I run an institution called the New America Foundation where the CEO of Google has been our chairman. We had Steve Ratner, who's now the auto czar, previously on our board, Roger Ferguson, the former deputy governor of the Federal Reserve. We have a lot of national security experts. A few years ago, we had a discussion about, first we sort of talked about, the geostrategic picture, and everyone wanted to sort of go commit suicide after it was so bleak. We had a discussion on the geoeconomic future, and not a single person, not Roger Ferguson, and this was an on-the-record forum, saw any problems ahead. And it reminded me of those people who thought that AOL and Time Warner would be, would merge well, that at some point, either the geostrategic picture, which was quite nasty, I said, would either get dramatically better because of the economic solvency and the benefits of high growth, that you could use wealth and the creation of wealth to help solve and smooth out a lot of the edges that we're seeing around the world, or the financial picture was going to be triggered by some collapse of confidence. And so I think there were a lot of folks, and I regret that some of the Chinese leadership were not there, but anyone looking at that picture, I think, would have had doubts about the sustainability. I have joked around a bit that President Obama has an economic advisory team. He's got a lot of CEOs in it. Eric Schmidt of Google is one of those. The president of Xerox, the CEO of Xerox, is another. And I try to use this in a metaphoric way to sort of explain to people what the challenges of the United States and China are. Today, to many countries, China looks like the Google of nations. A fast, high promise, high rising, fascinating place that has a weight and a value probably greater than its core underlying features deserve. America is like a well-branded, underperforming asset, like Xerox. I've owned its stock for 15 years and believe it's just gone down. And the challenge is to turn the United States into something that is more Google-like, but also not, I think China runs the risk in the way that it's organized its economy, and I think to some degree a lot of its commentary, that it runs the risk of being all fad and all veneer and have set itself up in an unsustainable direction. But the fact is today, and I agree with folks, that the United States and China are joined at the hip, and we have become quite indebted to China. There was a great piece by a John McCain economic advisor, Ken Rogoff, not too long ago called A Debtor's Empire. But what, again, being a Japan person for a long time and sort of being somewhat familiar with mercantile economic strategies, one can't avoid looking at the fact that China's done a very good job for a long period of time of moving its economic interests forward. And it has pulled off incredible miracles for its basic population, taking hundreds of millions of people, taking them out of poverty. But there's a point at which you become a market destabilizer with highly mercantile behaviors. And now we're at a point where we look at the global economic contractions, that behavior has to change. The United States made a huge mistake, in my view, by driving Chinese dollars into debt. If we had taken Chinese dollars and pumped them into infrastructure bonds, if we had brought them in and rather than letting our manufacturing base and the basic backbone of the American economy wither under the ridiculous notion, as we saw, the marketplace was not taking care of the smart power grid. It was not taking care of, I was in Korea recently and find it, just really stunning. I've got this damn cell phone from AT&T and it can't work in a building. But we're going through all the hills and mountains around Seoul, not a problem on the cell phone. It's before, you talk about Hong Kong, etc. Our infrastructure is lousy. Why weren't we using this partnership in a more constructive way early on to reinvest in the major parts? There are two people that often come up that I think are very important. We should reread Adam Smith. Adam Smith said there are essential roles and functions of the government. And part of that is investing in technologies that the market won't do, backbone and infrastructure, and taking care of certain things. And when America was out the resources and we were putting ourselves in a certain position where, in my view, we were having wars and not paying for them, you end up building up indebtedness, and those dollars, that trade, was going to go somewhere, and we used other money coming in very, very poorly, driving up further debt in, I think, a Wall Street-centric focus on growth and development, I think, that has come undone. In 1998-99, there was a very interesting economic forum in Hakone, Japan, that I went to. And it brought together many of the leading economic speakers and thinkers and policymakers in the region. This, of course, was in the aftermath of the East Asian economic shocks. I don't know if anyone addressed today. They're very important because they laid out almost in perfect detail a foreshock. I can tell I had through a lot of earthquakes, but the foreshock of what we saw today, saw in recent times. We saw the unwinding of LTCM, long-term, the LTCM, where Alan Greenspan, Bill McDonough, then the head of the Federal Reserve Board, and others got involved. This was a precursor to Bear Stearns, precursor to other bailouts, precursor to other sort of unwinding of firms that had a key part in the global economic framework. We also saw the collapse of confidence and trust in a region, and we also saw what happened when you basically had imbalances and shocks created by, I think, poor transparency and poor regulation. And we did nothing for 10 years. And Larry Summers and others at the time, and then Larry Meyer, the deputy governor, the vice governor of the Federal Reserve Board, said the world is dangerously overdependent on an American who overconsumes and underproduces. This is 10 years ago. And so it's criminal to some degree, in my view, that we've allowed the certain trends and the general economic frameworks that we've had in place to go on for so long, because what we've had in the United States is a decoupling, not between ourselves and the Chinese economy, but from essentially how capital and investment and wealth creation was detached from working families in the United States and the real economy. And that now has to be solved. And we're with fewer and fewer resources to be able to solve that problem. And it brings us to this really incredibly important question about China today. The world is divided between surplus countries and deficit countries. There are three big surplus countries, China, Japan, and Germany. And essentially all three of these made key decisions to remain in manufacturing or to build manufacturing. And China, I forgive a bit more than I do Japan to some degree for its role in these imbalances. And I don't forgive the United States for helping to organize along this way, but the notion that we had laissez-faire free trade economics design the sort of relationships we had with these surplus countries and our own economy just doesn't make sense. It just doesn't stand scrutiny. John Maynard Keynes worried about a lot of things, but among those were what happens when currency becomes a commodity. We're way past that. But he also worried about nations that structurally defect from the responsibilities of give and take within the global economy. Nations that either overproduce and underconsume or overconsume and underproduce at a large structural level. And I have to tell you, when I worked for Jeff Bingaman in the United States Senate, and we were at that time when Jeff was promised Bill Clinton to support the Uruguay round GATT legislation, which he did so in the proviso that a presidential commission be established to explore these structural deficits. 1995, 96, 97, that's what I worked on. Why did these happen? The Chicago School, University of Chicago Business School, said they're not supposed to happen. Yet we have them, and they're there. And so the imbalance between theory and reality have been glaring at us for a long period of time, and how these issues can be gamed, and the vested interests that I think have taken place of not wanting to deal with those. In my view, China has emerged from a rather successful and mercurial economic run as a nation with a lot of balance. It has not tried to upend the optics of the global order. It is worried about responsibilities that it is not ready to have. It has been loaning the avaricious appetite of the United States in ways that weren't really, in my view, completely economically rational. It's been doing its part to be a greater stakeholder. It's clearly been out multilateraling the United States. And so when you go back to Bob Zelek's notion of responsible global stakeholdership, China's been playing that role brilliantly. I think the United States hasn't, but we can't undo all of this muck that we've created very easily. The question is, where do we go now? And it is my view that as a surplus country, as a nation that has unique responsibilities, it's very important for China to help work with countries like ours. When Dr. Zhang spoke, he's, with all due respect, you and Tim Geithner are on exactly the same page, where you want essentially a strategy to reflate the American economy quickly. But let's face it, the American economy has been the just-in-time economy of just-in-time jobs, just-in-time money, just-in-time opportunity, where people had so much trust, they had too much trust. And China, Japan, other economies, I've always been interested in the folks that I've known there, and how little trust they had in their government, how uncertain they were about their future, how obsessed they were with savings for their children, their health, all these other issues. And they didn't have any just-in-time sense at all. Well, China, and then as I see power and as I see opportunity move to Asia, I think you're going to see a lot more trust in there, more spending. We're seeing China make important moves on expanding its social contract with people, and that means money and resources that will help stimulate Chinese economy, I think, in very globally responsible ways. But in the United States, we're not going to reflate back to an ever of 72% consumer-led GDP growth. It's going to be around 60%. That 12% is huge, and it means probably the flattening of Southeast Asian manufacturing or something along those lines. So given those realities, a reflation strategy doesn't get the world back. It just doesn't. And so when you read Martin Wolf in the Financial Times or you look at others, one of the things that we have not done very well, we've created some new opportunities with special drawing rights to get us past this crisis, but we've got to ask what will replace that gap in the American consumer. And to a certain degree, that's going to be a shared responsibility of China, of Germany. It's going to be a shared responsibility of the United States to reform how we create more of a savings and investment climate in this country. And I think that this can be done. And I've been fascinated and impressed with Chinese leaders who, on the whole, they say two things. They do agree with Geithner that you can take a reflation strategy, but on the other hand, I hear them saying, we know that America is busted. And I'll tell you, May 4th, when you have the results of the stress test on the American banks and the American banking system, watch for the shock waves. And we're going to be going through another round, in my view, of crisis here, doubt in the country, Chinese banking officials and economic officials saying, how could you have run your portfolio so badly? And we'll get out of the sort of momentary pause that we've had in the crisis and be back in those turbulent waves again. And I think it's going to be important for Chinese leaders to come out and say, we get it, we know, but we both have complicity. The idea that the United States itself launched, we triggered a global crisis. We didn't cause the global crisis. The underlying factors were very profound. China's been a fast-growing, important economy, and I take nothing away from it. But the period of that kind of mercantilism that helped drive Chinese economic growth needs to be brought down, and I think it is coming down. More investment, more domestic-led growth in China is critical. And in the United States side, frankly, we need to become slightly more mercantile for a while. We don't think about economic interests very well, and we need to come back and ask ourselves, if we gave too much to Wall Street, gave too much to an unregulated regime that was able to generate phenomenal growth in this country that was not shared with others, as it should have been in a stakeholder economy, how do we rewire that in a way that's healthy, not over-regulated, and in my view, not socialist? So why don't I end on that optimistic note and look forward to any questions or comments.
Well, thank you, Steve. Now we have questions. Well, maybe I'll give the first one to Richard.
Very good, all of you. I would like to ask a question that sort of derives from Steve's last point or two. And, of course, this does relate to the things that Martin Wolf has been saying over the past several months and indeed several years. I think if you were to sort of take his pessimistic view further, he would simply say the imbalances are not going to be redressed. You're going to get continued export surpluses, at least from Germany. You're going to get them still from China. You're going to get them still from Japan, and the deficit countries, the other Europeans, the United States, Britain, and so on, are going to become still consuming countries that do not do those very things that you're talking about. So in the longer term, what you forecast is if the U.S. is going to keep the international trading mechanism going, it has to essentially spend itself into the ground. In other words, the success of the world is the failure of the United States.
Right.
So how do we solve that problem, Mr. Lung?
Well, I think I'll rather turn to our panelists first, and then I'll offer my observations. Professor Zhang, would you like to offer some?
I just say very quickly that we've already seen Japan, for instance. Okay. Oh, Chinese have. Go ahead.
Answer now?
Okay. Well,
Okay.
I think the Chinese government has already said for a number of years now, and it's reflected in the Premier's address as well as in the government's plans, that they have to change China, not relying just on exports, but on increasing their domestic spending. Short term, in the 4 trillion stimulus package, it involved a number of measures other than those infrastructure. I think short term they are moving the consumption or encouraging the rural sectors to consume. China, with its large population, 1.3 billion people, you still have 55% of the population living in the rural areas. And unless and until you get these people, one, to make more money, and secondly, to start consuming, just by focusing on the 45% of the urban population will not be enough. So short term, what they have done is they have gone back a little bit to the coupon days, whereby they issue coupons to encourage domestic tourism. They issue coupons to buy kind of small farm machineries. They are asking the electricity appliance suppliers to go down to the villages to promote consumption there. But these are short term. Longer term, it has to go with the macro trends. The macro trends are, number one, China is determined that they would move towards more urbanization. the plan is that they will move from 45% of the population going to 55% urbanized in 10 years. But if you take any international norm, for a medium-stage industrialized country, the urbanization would be around 70%. So for the next 10 to 20 years, you'll be seeing every year about 15 million people becoming urban dwellers. And we observe that the spending pattern and the spending quantum of the urban dwellers are quite a bit larger and different from that of the rural people. And they spend, urban people spend a bit more on education, quite a bit more on other services, and that hopefully would change the structure of the Chinese economy. We all agree that the 35% with domestic consumption only accounting for 36%, it is not a very good thing. Historically, the highest in the last, say, the 30 years, domestic consumption actually accounted for about half of the GDP. So even if we move back to the historic highs of the past, I'm not saying that we have to somehow learn from the United States to go to 70%. Even if we move from 36% to 50%, that would be a huge kind of rebalancing of the Chinese economy. And hopefully with that, it will help America to save a bit more. Professor Zhang?
I think that this improved understanding happened not after the crisis, actually before the crisis, the problem. During the 17th Party Congress already, we adopted this new program and change. But this crisis make the officials, CEOs, and people more pressure. So I used to, if we thought that we need to change, but now we realize that we must change. So that means that measures will be taken more to change. But on the one hand, we have to understand this China phenomenon is not China's. It's globalization, reallocation of global production. So China actually represents the export of the multinational corporations. So this transition, will happen not very quickly. Otherwise, they have to close down all the factories. Or you find new places. It's very difficult to find new places. So they stand in China. Some of them will close down, but many of them continue. For China itself, I think this internal demand, and there are two kinds. One is crisis, measure, which can stimulate, as I mentioned, now in the first quarter is 4.3% of growth contribution, but that's not sustainable. So as a developing country, they need, still some time and to really build up a very strong, powerful inter-demand. But there are the other compensation ways, that is investment, because as a developing country, the potential is very huge. Taking the account this current 4 trillion package, and according to our system, that's usually central 1 yuan should multiply to 4 or 5. So the current total commitment from local government, it's around 20 trillion within the next 2 or 3 years. They now committed for 2 years. So that's, if I said 40% used for infrastructure, that is 1.2 around trillion US dollars investment on the infrastructure only. So after 3 years or so, you will see a new China, high-speed train, all the subways, urban subways, all kinds of things. The big investment, that can stimulate a lot of internal demand. But as I said, the problem is still manufacturing industry, because it's an accumulation of production capacity based on globalization. So it's a regional problem. It's not just China's. The first happened in Four Dragons, a very small scale. But now it happened when China emerged, it's suddenly become a big problem, big issue. It's for the global economy. And at the same time, U.S., gradually give up its production. because the bankers find easier to get a profit than the production. So the global, I think I call them probably in China we create the export engine growth to a dual engine, that is export plus internal demand, and then ideally after 10 or 15 years, and then we really can have internal demand-led growth model. So that's also happened in the drastic change of the regional production. That is why I emphasize the East Asia Regional Cooperation. And that is, if we successfully create this regional integration and help this regional economic demand, and that can help a lot. For instance, China just committed $10 billion for East Asia Investment Fund. And Japan will commit because of the leaders' meeting canceled, just China itself announced. So that creates some, a larger regional fund for use for improvement of infrastructure, can stimulate somewhat the regional internal demand, and then can help, the balance. So a lot of things we are doing actually, but it's not that quick, overnight change. Thank you.
Yes, the lady in orange.
Thank you. With that percentage increase of urbanization that's expected, that will have a huge impact on the environment. And so in order to contain that, you would have to be, I would think, in the future leaders in environmental remediation and technological innovation. So does that create an opportunity to collaborate with our companies? Because when we look at our industries, the only thing that where we're seeing any green is in green. And so could we perhaps, does that create an opportunity? And also in respect to your going out strategies in places like Africa and the Caribbean, are there opportunities that would be created to share technology and to focus on this green area as well?
Well, very good question, and obviously the other panelists can comment. Maybe I'll take the first step. Again, if you read the Chinese government's remarks, they have said very clearly that while they would like to pursue growth, they would like to pursue growth at a very different growth model, in a way different from that of the United States. I've said many times when I talk to friends, if we follow the growth model of the United States and take the per capita consumption of almost anything, be it iron ore, be it copper, be it oil, of the United States, and times 1.3 billion, which is the number of Chinese people, there won't be enough resources in the world to feed almost anybody. So the Chinese have said very clearly that they have to pursue a growth model that is very different, meaning they have to be energy efficient, they have to be resource efficient, as well as also environmentally friendly. So indeed, I believe they will embark, or they will kind of encourage development and importation of technology that would be, as you said, environmentally friendly. So clean tech would be very much preferred and encouraged. And also the kind of industries that helps recycle and reserve. So it is indeed an opportunity for everybody. And I'm sure a lot of investments will be made. As we have seen, Warren Buffett has invested in a firm that specializes in manufacturing kind of batteries for electric cars. And that company itself is also kind of manufacturing electric cars. And that, I think, is something that will see rapid development. After all, China, I believe last year, was producing as many passenger cars as in the United States. And the growth rate, I think, is slightly more promising over there. As far as the going out strategy, I believe you will see China going out to invest for their strategic good. Clearly, they need resources. Clearly, they need water, which means that they may be investing in land with water. And they would like to work with companies that can provide technology as well as markets for them. And to a certain extent, that is an opportunity for America. But on the other hand, I think the Chinese investors are mindful of the possible serious concerns, and so they would be very judicious in their moves.
Can I briefly comment?
Yes.
The only thing I would add, because you add the African development question on to your question, is that my sense is that China is moving very ambitiously to genuinely apply as much of the sort of, like Anthony Long said, clean technologies within its own system. When it moves into Africa and Latin American countries with others, which it has essentially the equivalent of like official development assistance, very involved with lots of infrastructure building projects, and also trying to build, and I think doing very important work. I frankly admire China's approach to development strategies and building much more than the sort of more philanthropic approach that the United States has had, which is much less effective. And when you look at what China's been doing there, what's interesting to me is to see that China has moved far enough up the economic chain that it's recognized that it needs to pay those costs, but it is not necessarily driving those things. It's not a philanthropic exercise to develop the Congo. There are other aspects coming on. So embedded in your question was the sharing of this technology. I don't see it happening.
Just as a side note, I'd just like to encourage you to check out the China Environment Forum here at the Woodrow Wilson Center if you're interested in this topic. We have a whole website dedicated to China's philanthropic and other environmental work.
Thank you. Bill?
Bill from Harvard. I have a question for Dave Richards. I was impressed with the optimistic view. When I look at the crisis that happened in Japan, and with China's bare avoidance of a great banking crisis, the decisive moments came in Japan after 8 years of dilly-dallying, when Mr. Takanaka was given a mandate to go to the banks and say, you really have to give an accurate accounting of your bad stuff. And when a very reluctant Diet, angry like ours today, was finally convinced that the end of the world was nigh for Japan unless they fully recapitalized the banks. I guess the pessimistic argument for early recovery of the U.S. would be that we seem to be not willing to recapitalize the banks fully. The estimates range from $500 billion to $1 trillion, depending on whether you believe the McKinsey study or the Norio Rubini studies. And we're fudging the accounting rather than forcing the kind of accuracy that came in Japan after 1998 and came in China when Lu Mingkang came to Hong Kong and said, he assembled a group like this and said, you'll see that the accounts of our bank are different, are completely inconsistent this year with what we said last year. And he said, that's because last year we weren't telling the truth. And we figured out that in order to clean up our bank, we have to tell the truth both to you and to ourselves. Have we gotten to that point, or can we avoid coming to that point?
Well, Bill, you've asked a very tough question. I think it can be done. I don't think anybody knows, not even the bankers themselves, know exactly what their position is. And the credit default swap market makes the calculations very, very difficult because the estimates, as I understand them from Rubini and some of the others, and I think these are like $3 trillion or something like that, they're even bigger than the ones that are based on the market prices that the credit default swaps theoretically reference to the loan positions of the banks. And they're very different kind of vehicles, and the credit default swap being sort of a bet on default by people who, on the one hand, in the present market, there are very few people writing credit default swaps. I mean, if you think of how dangerous they are, it's been proven by what happened to AIG. Very few people of any substance are willing to write these credit default swaps, except at prices that really wash out virtually almost any risk. And the people buying them are often quite desperate to neutralize a position that they've already taken on, to stabilize their balance sheets for regulatory purposes. And when the banker says, well, the discounted present value of these loans is much higher, I think they're probably correct. Now, at the same time, they do have a big interest in lying. And so it's difficult to know what they really believe. Now, the value on a discounted cash flow basis of these loans depends on things beyond the banker's control. It depends on how much reflation is developed in the economy. At what point do housing prices stop going down? Much of the concern is that houses are going to continue to go down. There's some evidence that they're actually beginning to stabilize, at least in many areas. With zero interest rates and the Fed subsidizing mortgages at 4.5%, you have a huge amount of refinancing and purchases of first-time buyers, which you may be seeing some sort of bottoming out process, in which case the sort of stress tests that assume further declines in the economy and housing, while one could say that's prudent, they may be too pessimistic. And I don't know. The bankers clearly, on a pre-provision basis now, are very profitable in the United States. I think I would argue that the real estate boom in Japan and the capital ratios of the banks during the boom were both more extreme than they were in the United States. When you had the value of the Imperial Palace greater than the state of California, that sort of thing, clearly we never reached that in the United States in any area that I know of. Secondly, the Basel agreements that were developed in the late 80s to stabilize or to standardize bank reserve requirements were basically stimulated by the very low capital requirements of the Japanese banks, that because their capital requirements were so low, they could make loans at a profitable basis that were much more favorably priced than Citicorp or Chase or Barclays or any of these other banks. And so there was a complaint by the Western banks that this was not a level playing field. And the attempt was to say, okay, let's stabilize the reserve requirements of all the international banks. And so the Japanese banks started at an undercapitalized level that I think was more undercapitalized than ours was, so that there was less cushion there. And I think the final point I would make is that throughout that period where they didn't do much, the Japanese economy faced the growth of China in a way that was even more acute than it was for the United States industrial base. And with China growing, and you had the hollowing out of, beginning with, motorcycles and then cars. I mean, there were industry after industry that closed down. They're still closing down and moving to other areas in Asia, partly because of the Chinese monetary policy and export idea. So, Bill, I don't know the answer, but I'm impressed with, as I said in my remarks, the extent of the stimulus programs that are in place, not only in China, but in Japan, Europe, some are greater, some are less. We've clearly been doing it. And secondly, the basically reflationary policies of the central banks. And that's very, very powerful. And to the extent that you begin to see people borrowing and turns in certain parts of the economy beginning to happen, you can change confidence, and when you do, the excess capacity that you have in the economy that some people would say is deflationary. You're going to have more deflation because you're only operating at 80% or 60 or whatever it is. That capacity actually can be turned on at very low cost, and you can get a very sudden turn. And often it's stimulated by inventory changes. And this, when it happens and people start, singing the song, you never know. So, I mean, who knows? I mean, the question of Citicorp, Bank of America, the stress tests, the uncertainty that was pointed to that could develop as a result of the requirements, that is an uncertainty that I think actually slows it down. It makes it, a bank is, when he's told to be, he's undercapitalized, one way you can help your situation is by not making loans. So it's actually an incentive for not doing what they should do. But those banks are not the only banks in the United States. There are a lot of banks in the United States. And these banks are now in a situation where the profitability of making loans is really extraordinary.
Well, on that note of, I would call it optimistic uncertainty, since I noticed that we have gone beyond the time, I thank the panel and I thank the audience for this session. Thank you very much.
Okay.